The German military just failed to buy fuel, not because the money wasn't there. Germany announced a $100 billion defense fund. The authorization existed. The procurement order was submitted. It was rejected because fuel prices had risen so fast, so far above the baseline assumptions built into the procurement approval system, that the system itself could not clear the transaction. The Bundeswehr, one of the most well-funded militaries in Europe, could not complete the purchase of 92 diesel tank containers. That is not an anecdote. That is a live measurement of what energy-driven inflation looks like when it reaches the implementation layer of a real economy. And it happened this week. Right now. While you were watching other headlines. Welcome back to Recession Warnings. Today is Wednesday, April 29th, 2026. And I need you to understand something before we go any further. What is happening today is not a normal market day. Today is the day 4 separate systems, monetary policy, energy architecture, geopolitics, and equity markets, are all reaching critical inflection points simultaneously. On any one of these axes alone, the implications for your money would be significant. Together, on the same day, they create a convergence that the mainstream financial media is not connecting, not fully, not in a way that shows you what it actually means. I'm going to connect it, all of it. And I'm going to show you exactly where silver sits inside this picture, because where silver sits right now is not where it will be sitting when these forces finish playing out. Let's start with the thing that is moving silver's price today, and why that movement is not telling you the truth about what silver is actually worth right now. Silver is down on the day. Paper price sitting at $72.54. And if you're watching that number in isolation, you might conclude that the market is calm, that sentiment is mixed, that there's no particular urgency. That conclusion would be wrong. And here is why. There are 2 silver markets operating simultaneously right now. The one you can see, the futures price on your screen, and the one running underneath it, the physical delivery market, where actual silver bars move between actual vaults. Those 2 markets are supposed to track each other closely. When they diverge, when the paper price says one thing and the physical inventory says another, it is one of the most reliable structural signals in commodity markets. And right now they are diverging. The COMEX delivery pressure on physical silver has not eased, not even slightly. For weeks, the gap between what is being committed to on paper in the futures market and what is physically sitting in certified vaults available for actual delivery has been widening. No large-scale physical metal movement has bridged that gap. No meaningful drawdown of certified inventory has corrected it. The pressure remains fully intact. Here is what that means in plain language. The price you are watching is a paper price. It reflects what traders are willing to commit to on futures contracts. It does not reflect the reality of physically available silver in the delivery chain. And historically, when those 2 things diverge this sharply and this persistently, the physical market eventually reasserts itself. It does not ask permission. It does not wait for a convenient news cycle. It reasserts. The question is, what triggers the reassertion? And today there are more live triggers stacked on top of each other than on any single trading day in recent memory. The trigger that moved silver's price this morning came from a microphone. President Trump stood in front of cameras and told the world that Iran had contacted him directly, that Iran had communicated it is currently in a state of collapse. No date was offered for when this supposed contact occurred. No name was given for who placed the call, no transcript, no named intermediary, no supporting documentation of any kind, just the assertion, Iran is collapsing. This changes the negotiating landscape. Wall Street bought it. Of course it did. Trading algorithms are not built to interrogate sources. They are built to react to signals. Risk sentiment shifted. Silver, which had been pricing an elevated geopolitical tension as a structural bid, softened on the implication that a Gulf resolution might be approaching. But here is what we actually know happened. The White House formally rejected the Iranian mediation proposal transmitted through Pakistan on the same day. The stated reason: Iran insisted on leaving its nuclear program as a topic for later negotiations. Washington's position is that no framework is acceptable unless nuclear capitulation is unconditional and upfront. That is not a ceasefire posture. That is a regime change posture wearing diplomatic clothing. Brent crude is sitting above $98 right now. Oil does not care what a president says into a microphone. Oil prices what it knows. And what it knows is that the Strait of Hormuz has been functionally closed to normal tanker traffic since April 13th, 2026. That is over 2 weeks of restricted flow through one of the most critical maritime choke points on the surface of this planet. The United Arab Emirates, the third largest oil producer on Earth, has had its tanker activity through the strait effectively shut down. 95% of Abu Dhabi's state revenues flow through that waterway. Iran has been deploying the strait as a military pressure lever, running drone and rocket operations against UAE infrastructure targets with sustained regularity for weeks. Silver today is reacting to a headline. The headline is not the reality, and the gap between those two things is precisely where the opportunity lives. Now I want to talk about something that almost nobody in mainstream Western financial media is treating with the weight it deserves. In 48 hours, not next year, not next quarter, not at some future policy review, in 48 hours, on May 1st, 2026, the United Arab Emirates formally withdraws from OPEC. After 58 years of membership, let that land. The third largest oil producer on this planet is walking out of the cartel that has structured global energy pricing since the early 1960s. A country that was in an open public quota dispute with Riyadh as recently as November 2024 is not negotiating better terms. It is leaving entirely. The official statement cites the need for greater production flexibility to reach a 5 million barrel per day capacity target by 2027. That is the press release version. The structural version reads differently. The UAE is a country under direct Iranian military pressure, economically dependent on a waterway its active adversary controls militarily, operating inside a cartel that has historically accommodated Iranian interests when geopolitically convenient. The calculus of cartel loyalty changes when 95% of your national income is tied to a waterway your enemy is using as a weapon. There is no quota negotiation that offsets that. So the UAE is not negotiating. It is walking. This is being characterized by serious energy analysts as the second largest structural shock to global energy architecture in the past 60 years. The first on that list is the Saudi petrodollar agreement of 1974. The arrangement Henry Kissinger personally negotiated that made the dollar the mandatory settlement currency for global oil transactions and which created the foundational architecture of modern dollar hegemony. The UAE exit does not carry that level of historical magnitude in isolation, but it belongs in that conversation, because what it signals is the fracturing of the cartel structure that has held energy pricing within a controlled, coordinated framework since before most of you were born. What remains after the UAE departure is Saudi Arabia anchoring a significantly reduced cartel. 5 relevant producing nations stripped of the unified negotiating leverage that made OPEC meaningful in the first place. Washington has achieved, through the pressure of this conflict, something it has been pursuing for decades: the fragmentation of OPEC's collective pricing power. The cartel that OPEC was in its full form is effectively finished. This matters for your money in a very direct way. The dollar-denominated energy pricing structure that has underpinned global dollar hegemony since 1974 is now visibly cracking. When dollar-denominated structures fracture, assets that exist outside the dollar system, physical precious metals, begin absorbing the capital reallocation that follows. We are watching that process begin in real time. And here is the part that should be getting more attention than it is. The West is not buying silver right now. Physical product is available at or near spot. Western retail participation in this market remains subdued. Meanwhile, China imported approximately 836 metric tons of silver in March alone. That is nearly triple the 10-year average for the month of March, which sits at approximately 306 metric tons. Chinese retail investors are purchasing small-format silver bars aggressively. Chinese photovoltaic manufacturers stockpiled ahead of export tax policy changes. Chinese silver prices have been trading at meaningful premiums to international benchmarks, pulling physical metal eastward through arbitrage flows with Hong Kong serving as the primary transit channel. The West is not buying. The East cannot stop buying. COMEX delivery pressure is unresolved, and the structural drivers of all 3 of those conditions are not reversing. They are compounding. Hold that picture. Because now I need to show you what is happening in Washington today and why it connects to everything we have just discussed in ways that the financial press is choosing not to say out loud. Today is Federal Reserve Day. Tonight, at 8 p.m. Eastern, the Fed announces its rate decision. The CME probability model currently prices a 100% probability of a hold at 3.75%. There is no uncertainty about the number. The market has fully priced it. So if the decision itself is already known, why does today matter? Because what is happening around today's press conference has nothing to do with the rate decision and everything to do with what the Federal Reserve is going to be 1 month from now. Jerome Powell is delivering what may effectively be his final press conference as the meaningful decision-maker of American monetary policy. Not because his term has expired, his term runs through 2026, but because the mechanism to replace his influence over policy has already been activated, and the sequence by which it was activated is worth understanding precisely, because it tells you something important about where interest rates are going and what that means for every asset you hold. Here is the sequence. The Department of Justice, operating under a direct Trump appointee, dropped a criminal investigation into Jerome Powell. That investigation concerned renovation cost overruns at Federal Reserve headquarters. It was closed. No charges filed. On the same day, the Senate Banking Committee voted on the nomination of Kevin Warsh to effectively succeed Powell in directing monetary policy. Warsh sat on the Federal Reserve Board in 2008. In every public forum since, he has aligned his stated views on interest rates with whatever the prevailing Republican leadership required. Trump has stated explicitly, not implied, stated, that he intends to co-design interest rate policy going forward. The investigation into the sitting Fed chair was dropped. The replacement is being confirmed today. The press conference is tonight. Connect those three events in sequence and tell me that is a coincidence. An independent Federal Reserve functions as a structural constraint on money creation. A captured Federal Reserve, one where rate decisions align with executive political priorities rather than economic data, does not. When monetary discipline becomes subordinate to political necessity, the rate of currency debasement accelerates. And when currency debasement accelerates, the purchasing power case for holding physical silver does not soften. It hardens. The transition happening in Washington today is not routine. It is the most consequential shift in American monetary credibility in at least a generation. The market is treating it as procedural. It is not procedural. And the silver price, sitting at 70 Tau 54 on paper while physical delivery pressure remains unresolved, is not reflecting it yet. That is the lag. That lag is the opportunity. Now let me give you the economic numbers that are not leading the financial headline cycle but should be. The Atlanta Federal Reserve's GDP Now model is currently tracking first quarter annualized U.S. growth at 1.2%. The mainstream Wall Street consensus for the same figure runs between 2% and 2.5%. That is not a rounding difference. That is a structural divergence between what the model is seeing in the real data and what the consensus narrative requires. If tomorrow's Q1 GDP advance estimate comes in anywhere near the Atlanta Fed's model, the United States is not in a growth environment. It is in a stagnation environment with inflation running above target. That is the textbook definition of stagflation. Not a word people use casually, not a word that should be used casually, but it is the word that fits the data that is printing right now. In Germany, the IFO Business Climate Index fell to 84.4 in April, down from 86.3 the prior month. Anything below 100 is contractionary. 84.4 is the lowest reading since May of 2020, the deepest phase of the first COVID lockdown. Germany's official growth forecast for 2026 has been cut in half, from 1% down to 0.5%. The 2027 forecast trimmed from 1.3% to 0.9%. Fuel prices across most major German cities are now well above €2 per liter. The government's emergency response is a €1.6 billion fuel tax relief measure valid for 2 months. After that, the price stays above 2.20 and the relief disappears. And then there is the Bundeswehr story I opened with. The German military holding a €100 billion special defense fund, unable to complete the purchase of 92 diesel tank containers because prices had risen to levels the procurement authorization system could not approve. That is not a headline. That is a direct measurement of what energy-driven inflation looks like at the execution layer of a real government in the world's fourth largest economy in April 2026. When a fully funded military cannot clear a fuel purchase, the macro environment for hard assets is not softening. It is hardening faster than any consensus forecast currently acknowledges. Now I want to bring this all together with what happens tonight after U.S. markets close. Because tonight, 4 of the 5 most valuable companies on this planet report quarterly earnings simultaneously. Microsoft, Amazon, Alphabet, Meta, combined market capitalization, approximately $11 trillion. In a single hour, $11 trillion of equity value will either be confirmed or challenged. And this connects directly to silver in a way that is not being discussed anywhere. Here is why it connects. Microsoft's key figure tonight is not headline revenue. It is the Azure cloud growth rate in constant currencies. Management guided 37 to 38% growth in February, and Microsoft has committed to spending over $100 billion on AI infrastructure in the current fiscal year alone. If the Azure number cracks, if the AI capital expenditure narrative starts to look like overspend without proportional return, that repricing does not stay inside Microsoft. It spreads. It spreads across the entire AI infrastructure trade, and it spreads into assets that have already started showing fractures this week, with major names in the semiconductor complex down 4% or more, following reporting on missed revenue targets at key AI players. Amazon needs its cloud segment to be the 3rd consecutive confirmation after Microsoft Azure and Google Cloud that the AI infrastructure spending wave is real and durable. A disappointment there is not an isolated data point. It is a 3rd crack in the same story within the same week. 3 cracks in the same narrative in 7 days is not noise. That is a structural signal. Alphabet is already expected to show a profit decline year over year. A U.S. antitrust ruling from January formally prohibits Google from paying Apple and Samsung for default search placement. Their core revenue engine is being dismantled by regulation, while AI investment spending climbs simultaneously. That is not a company in a strong position entering an earnings report. Meta is guiding 31% revenue growth, but its metaverse division is burning between $4 and $5 billion every quarter with no commercial product to show for it. And its AI infrastructure commitment for 2026 runs between $60 and $65 billion. If tonight's collective earnings disappoint, if even 2 of these 4 companies produce guidance that shakes the AI capital expenditure narrative, capital begins to rotate. $11 trillion does not evaporate. It moves. And in an environment where the Federal Reserve's independence is structurally compromised, where the Strait of Hormuz has been contested for over 2 weeks, where OPEC is fracturing in real time, where U.S. GDP is potentially printing at stagflationary levels tomorrow, and where physical silver delivery pressure remains unresolved while China is importing metal at triple historical averages, in that environment, rotating capital does not park in 3.75% treasuries. It looks for stores of value. And the stores of value that exist outside the dollar system, that cannot be printed, that cannot be captured by a political appointee, that have been absorbing Eastern capital flows for months while the Western retail investor has not yet arrived. Those are precisely the assets we have been describing for the past hour. Let me now connect the final piece that mainstream financial coverage is deliberately keeping separated. German inflation in April is expected to print at 3% year over year. The prior reading was 2.7%. That is a 30 basis point acceleration in a single month in Europe's largest economy, while growth forecasts are being cut in half simultaneously. Rising inflation and falling growth. In Germany, in the United States. Potentially confirmed tomorrow by the GDP advance estimate. These are not isolated national data points. These are synchronized signals from the 2 largest Western economic blocs pointing in the same direction at the same time. The European Central Bank meets tomorrow. A hold is currently expected, but the data is forcing a conversation that central bankers would prefer not to have publicly. What do you do when inflation is rising and growth is collapsing? You cannot raise rates to fight inflation without destroying growth. You cannot cut rates to support growth without accelerating inflation. That is the stagflation trap. And once you are in it, there is no clean exit. Every tool available makes one problem worse while addressing the other. Physical silver exists outside that trap. It is not a liability on anyone's balance sheet. It cannot be debased by a political decision made in a Senate committee room. It cannot be disrupted by an antitrust ruling. Its supply does not expand because a Fed chair is replaced. It is finite. And it is being accumulated by the eastern half of this planet at a pace that has no recent historical parallel, while the Western retail investor is still watching the paper price on a screen and concluding that things are calm. Things are not calm. The paper price and the physical reality are telling different stories. The monetary architecture that has governed dollar hegemony since 1974 is cracking at multiple points simultaneously. The most consequential shift in American monetary credibility in a generation is being processed as a procedural footnote on a Fed decision day. And four companies worth $11 trillion are about to either confirm or fracture the single largest investment narrative in equity markets. This is Recession Warnings. If this analysis gave you something the mainstream financial media did not, share this video with one person today. One person who needs to understand what is actually happening right now. Subscribe if you have not already. Drop a comment below. I want to know, do you think the Fed's independence is already gone? Or do you think tonight's press conference proves otherwise? Let me know. I read every single one. I'll see you in the next one.